All right, let's dive right in. We're going to tackle one of the biggest questions every investor has to ask themselves. Do you go all in on the market with an S&P 500 index, or do you zero in on the slow and steady power of dividend stocks? We're going to figure out which one is the real path to building serious long-term wealth.
I mean, it's the ultimate question, isn't it? How do you actually build real, lasting wealth? It's not just about picking a hot stock or getting lucky on a price jump. As we're about to see, there's a much quieter and, frankly, a much more powerful force at work. You see, there's this hidden engine humming away in the market. It's responsible for a massive chunk of all the long-term gains. But, it gets overlooked all the time. It's really the difference between just owning a stock and having that stock actively pay you for owning it.
And here it is. This is that hidden engine in action. Just look at this. Since 1930, if you put $1 into the S&P 500, just based on price, it would have grown to $278. Pretty good, right? But if you took the dividends and reinvested them, that same dollar would have absolutely exploded to over $9,500. This one chart says it all. Over the long haul, compounding dividends are what create truly mind-blowing wealth.
So this really sets up a fundamental choice for all of us as investors. Do you just try to capture the broad market's growth, kind of hoping that a rising tide lifts all boats? Or do you get more specific and focus on the companies that have truly mastered the art of sharing their profits with you, the shareholder?
So let's meet our contenders. In one corner, you've got the market powerhouse, the heavyweight champ, the S&P 500. And in the other corner, we have the compounding champion, dividend growth investing. Okay, so S&P 500 indexing is pretty straightforward. You're basically buying the whole haystack. You own a tiny piece of the 500 biggest companies in the US. Simple. Dividend growth investing, though, that's about being picky. It's about carefully picking out the best needles from that haystack, the companies that don't just pay you, but have a long, proven history of giving you a raise year after year after year.
And the absolute gold standard for these companies is the Dividend Aristocrat. And trust me, this isn't just a catchy name they made up. To earn this title, a company has to increase its dividend payout for at least 25 years in a row. No breaks. Think about the financial strength and discipline that takes. It's a huge signal of a rock-solid business.
All right, so we know our contenders. Let's get them in the ring for round one, the total return battle. Where is the money really coming from with each of these strategies?
Now, you might think the S&P 500 is all about stock prices going up, but even for the broad market, dividends are a huge piece of the pie. Look at this. Since 1926, almost a third of the S&P 500's total return came from reinvesting dividends. That's not just a little bonus, it's a core part of the market's engine.
But let's be real. Today's S&P 500 is heavily driven by capital appreciation, just the stock prices themselves going up. And a lot of that growth has been pulled along by a handful of giant tech companies who'd rather pour their cash back into growing the business instead of paying out big dividends.
Dividend growers, though, are running on a dual engine. It's a two-for-one deal. You get the potential for the stock price to rise, which is great, but you also get that separate, steady, and growing stream of cash from the dividends. And that commitment to raising the dividend? It's usually a sign of a really high-quality company with its act together. Okay, I can hear you asking, but wait, why would I want a small, growing dividend when I can get a big, high-yield one right now? It's a totally fair question, and it gets right to the heart of what this strategy is all about.
And this chart is the answer. It's so simple, but so powerful. That top line is a nice, high 5% yield, but it never grows. The bottom line starts lower, at 3%, but it grows by 10% every single year. And just watch what happens. Over time, that compounding growth doesn't just catch up, it completely leaves the stagnant high yield in the dust. This proves it. For long-term income, the growth of the dividend matters way more than where it starts.
So, making money when the market's flying high is one thing, but what happens when the storms hit? Let's take a look at how these strategies actually hold up when things get tough. Are they built just for sunny days, or can they navigate the rough seas?
Because here's a secret to getting wealthy. It's not just about how much you make in the good years. It's about how much you don't lose in the bad ones. Protecting your money during a downturn is what really lets that compounding magic do its work over the decades.
And the data here tells a really interesting story. Over 15 years, the Dividend Aristocrats actually had a slightly lower return. But, and this is a huge but, look at the volatility. It's lower too. That means they delivered those solid returns with a much, much smoother ride for the investor.
less drama.
So why is it a smoother ride? Well, part of it is just simple: cash. When stock prices are falling off a cliff, those dividend payments just keep showing up in your account month after month. It acts like a cash cushion, offsetting some of those paper losses and giving you a real return when everything else is red.
Now, on the other hand, the S&P 500, which we all think of as the definition of diversification, has a kind of a hidden risk that I think a lot of people just aren't aware of.
And here it is, almost 34%. Over a third of the S&P 500's entire value is concentrated in just 7 giant companies. So that diversified index fund you own is actually making a massive, massive bet on a tiny handful of stocks. If those giants stumble, everybody feels it.
All right, so we've compared returns, we've looked at growth, we've talked about risk. It's time for the final verdict. Which one of these is the right strategy for you?
Well, it really just comes down to your own goals and how much risk you're comfortable with. The S&P 500 is a pure growth engine. It's fantastic for investors who have a long time to invest and can stomach the ups and downs. The Dividend Aristocrats, though, they're more of an all-weather vehicle. They blend that growth with a rising income that helps cushion the blow when the market gets stormy.
But maybe the most important takeaway is this. These strategies aren't rivals. They're not enemies. They're just different tools in the toolbox. The smartest investors don't pick one side. They figure out how to use both to build a portfolio that's stronger and more resilient.
And that leaves us with one final thought. The real question isn't which strategy is better, it's which one is better for you. So take a look at your own portfolio and ask yourself, is it built just for the good times, for the sunny bull runs, or is it truly ready for any storm the market decides to throw its way?